Welcome to this week's episode of Control Cash, your no-nonsense guide to personal finance. Common question people have when first getting into dividend investing is it better to have monthly paying dividend stocks or quarterly? Today, we're going to be comparing the two to see which one we can crown the winner. If you are a dividend investor like me and this type of content interests you, be sure to like and subscribe for more. To begin, quarterly dividends are more common, meaning you get paid once every 3 months, typically in March, June, September, and December. Monthly dividends are exactly that, meaning you get paid 12 times per year. Each type of dividend comes with its advantages. Let's start with the benefits of monthly payers. Number 1, smoother cash flow. If you're retired or living off your dividends, getting paid every month makes budgeting a whole lot easier. Considering most people create monthly budgets, getting paid each month makes tracking spending much easier. Number 2, faster reinvestment. If you're enrolled in DRIP, those extra payouts can get reinvested sooner, letting compounding work just a little faster, which can impact long-term returns over the course of 10 to 20 years. Number 3, psychological boost. I'll admit it just feels good to see money coming in every month. It keeps you more engaged with your portfolio and gives you the momentum to keep investing and contributing every month. Some examples of stocks that pay monthly are Main Street Capital, Realty Income, and even some covered call ETFs like QYLD and JEPI. Now for quarterly payers. Number 1, they're usually bigger, more established companies. Many of the strongest dividend growth stocks like Johnson & Johnson, Microsoft, and Coca-Cola pay quarterly. These companies are huge and have established themselves as key players in each one of their niches. Number 2, potential for more stability. Many companies with quarterly payouts tend to have lower payout ratios and more conservative dividend policies, which can mean less risk of dividend cuts. This also gives the company a chance to make adjustments in strategy month to month without having to worry about paying investors right away. Number 3, focus on growth. Less frequent payments can mean the company spends less on administration and more on reinvesting into the business. This can allow more capital to flow into reinvestments that will return more in the future. Now that we've looked at the pros, let's actually put some math behind this and see how it plays out over a long-term investing timeline. For this example, we'll use one of the most well-known monthly payers out there, Realty Income, ticker symbol O. We'll start with a $10,000 investment, reinvest every dividend through a DRIP, and assume the company keeps growing its dividend at its historic average of 4.26% every year, with the share price also growing at 3.11% each year. Scenario 1, monthly dividends. After 10 years, that $10,000 grows to $24,241. You own 307 shares, and you're pulling in about $1,400 a year in dividends. Scenario 2, quarterly dividends. Same start, same growth, but after 10 years, the portfolio is just $23,839 with 302 shares and about $1,342 in yearly dividends. That's a $402 difference in value and less than a $100 difference in income every year. The difference is subtle, and the only thing we changed was payout frequency. The crazy part is that this only reflects 10 years of investing, meaning that if you were to allow this investment to compound over 20 or 30 years, the difference would be even greater. Above all else, what this really shows is the power of faster compounding. When you get paid more often, you're able to put that money back to work sooner, and over years or decades, that small timing advantage can snowball into a huge difference. In our example, monthly dividends didn't just produce a slightly bigger portfolio, they also produced a slightly higher income in dividends. Now, that doesn't mean you should only buy monthly payers, but it's a reminder that payout frequency can be a real advantage if you're focused on maximizing long-term income growth. This is another reason why the common saying is, time in the market beats timing of the market, meaning the sooner you get in and start investing, the more time this money has to work for you. At the end of the day, the best portfolio isn't made up of just monthly or quarterly payers, it's a healthy mix of both. Personally, I hold more monthly payers than quarterly ones because it gives me the momentum boost to keep investing consistently every month. But ultimately, it's up to you to decide which strategy fits your goal. Monthly dividend stocks can give you smoother cash flow and a slight edge in compounding, while quarterly payers often come from larger, more stable companies with decades of proven growth. By combining the two, you can enjoy predictable income now while also building long-term wealth with rock-solid dividend growers. Remember to do your research, and as always, diversification is the key. If you are on your dividend journey and you're looking for reliable dividend stocks, go check out my video on the top 5 monthly paying REITs. Let me know in the comment section, which type of dividend stock do you like more, monthly or quarterly? Thank you for watching Control Cash, keep investing, keep stacking dividends, and I will see you for the next one.